Good morning, everybody. Am I audible?
Good morning, sir. Yes, you are audible.
Please go ahead.
Good morning, everybody. I welcome Dr. Abhijit Fadnis. I welcome all of you. We have already sent the brief profile of Dr. Abhijit Fadnis, who is a regular contributor to our programs of PV Bhagwat Investment Guidance Cell. He has always participated in all our finance fair. He is our friend. He is a doctorate from IIT, chartered accountant, cost accountant, CFA, company secretary. With all these qualifications, he is a humble man from M.L. Danukar College of Commerce, and he is the student of Principal M.D. Limaye, who is the founder of this PV Bhagwat Investment Guidance Cell. So without wasting much of our time, Abhijit, I welcome you once again, and I request you to start the proceedings. Take the mic with you. Dr. Abhijit. Abhijit, you are muted.
Okay, my apology. I didn't realize I was on mute. So Adarniya Dhere sir, Anilji Londe, Secretary of the Cell, Dhruvaji Patil. I see a lot of familiar names here, but Udayjit Ardalkar, Sujit, and many friends. I can see their names here, Manoj Sathe, of course, many others. So I appreciate your participation, and I must also thank the organizers for having thought of me and giving me the opportunity to share my thoughts. And as Devesh sir said, I think this must be perhaps my 5th or 6th time that I'm participating. Most of those topics were on the periphery of investing, not much about equity investing strategy. They pertain to corporate governance. I spoke about SIP, myths and reality. I have spoken about some of the other aspects, but this is the first time I'm actually talking about so much of an equity related strategy, and for having given this opportunity, I'm grateful. So I'll share my presentation now, and Sujit, if you could kindly confirm that it's visible, then I can get going with it. Is it visible, please?
It's coming, sir. It's coming. Yeah, perfect.
Yeah. Okay. So welcome once again. Really appreciate your participation. A few disclosures and disclaimers, because we are talking about equity strategy, and therefore, I must disclose here that over the last 12 years, I have taken to investing through holding and investment companies, about which I'm going to talk about today. And since I have been studying that approach for quite some time, so I therefore have, as a percentage of my small portfolio, it's a significant portion of investment. So that is one disclaimer and disclosure I want to give. And therefore, to that extent, naturally, there is a certain amount of bias in my presentation, because I have been following that route. And therefore, I would appeal to all the viewers to examine my presentation independently, critically, and take the decision. There could obviously be limitations of my analysis, the way I have looked at this investing, and you should consider counter views also before you finalize your own strategy. And towards the end, I may mention a few names. That list is not necessarily exhaustive. It's more for illustration. And again, I leave it to the audience to make an informed choice about which companies to invest in, etc. Even in the YouTube videos that I have been creating, I never talk about any individual name, because my objective is to give perspectives to people, and people should use those perspectives and critique them and use them to their advantage. And that's my sincere desire. So in that sense, not being registered with SEBI as a portfolio advisor, and that not being my primary profession, I have stayed away from taking any names, so to respect SEBI's ethos of guidelines, so that I don't err on the wrong side of advising people on which stocks to invest when I'm though eminently qualified from professional qualifications perspective, but not somebody who has this profession of portfolio management, and therefore having not sought that registration, I have simply stayed away from that. While I see on YouTube, I see a lot of people actually talking about companies, and I'm sure they may have a reason to do so. So that's the background I wanted to build before I go into the subject matter. And here, before I go into the subject matter, I'll also talk about a few reasons why I turned to holding and investment companies. It's always good to be forthright in terms of this question, why, so that you also get a perspective. And one point I wanted to make before I actually unfold the slide is that over last about 15 years that I have actually actively moved to equity investing. The first time I did was in 2006. Prior to that, it was just a few IPO applications and that kind of thing, which was not like a serious equity investing. The first time I turned to equity investing seriously was in 2006. And one of the things I have realized over the last 15 years is, the success in equity investing is actually to manage your risks better. I see a lot of people chasing returns, and in the process, actually, perhaps they're not able to generate the return that they desire, and inadvertently they invite risks which are uncalled for. So one of my learnings, the key learnings over the last 15 years is essentially equity investing is about managing risks. Returns are a byproduct, and returns do happen, but instead of chasing returns, if you manage your risks well, you are able to allow returns to happen. So that's the way, let me put it. And if any of you are interested, some of the things which I'm going to talk about, there are some YouTube videos that I have also created. I'll be very happy to share that link to Dhruvaji and Dere sir. And of course, it can be shared with all the members if that interests you. So one of the reasons which also prompted me to look at holding and investment companies was the issues that I faced while relying on the tall corporate governance claims of companies. And today I don't want to take those names. I have taken names earlier in a seminar organized by our own cell, when I had given a lot of illustrations of why I have become a corporate governance skeptic. So today I don't want to labor on that. But essentially, one of the things I have realized is that in the corporate world, and there is another thing which I also want to disclose, again, that's not a part of, I think there is a point on that, so I'll come to that a little later. But what I have observed in companies, and my primary profession, though again, I don't market my services, is that wherever companies have invited me, I have delivered corporate workshops for companies, and I have done so for more than 70 companies across 20-25 sectors. So that way, I have seen a lot of companies closely. And what I have found is that, and also as an investor, that corporate governance can be layered into two levels. One is the operational governance, in which they look at systems, processes, the supply chain, the distribution, and they are great companies in that. When it comes to the higher level of governance, there are clearly a few challenges. And again, I don't want to labor on those details, but one thing that can be easily observed across companies are a few things which I'm mentioning here. One is the unreasonable compensation to both executives, executive directors as well as non-executive directors. And while I have spoken about this in our own conference many years ago, it's recently that I have seen that SEBI also is now taking some initiatives on the non-executive director compensation, and which is a good thing, because otherwise what we see is that the non-executive directors walk away with massive compensations, and naturally they cannot resist massive compensation to the executive directors. So it becomes like you scratch my back and I scratch your back. So that's one problem. The second problem is stock options quite often are issued at times during market downturns. While the whole mutual fund industry tells us that nobody can time the market, somehow when it comes to issuance of stock options, all the managements have a great knack of timing the market. So typically you'll find that while at that time never rights issue will be offered or never shares will be issued to private equity investors, they are issued to employees as a part of stock options. So so this is another major conflict of interest. The EPS gets diluted through the stock options, but we have this clamor for big names and we get carried away with that. So be it. But that's another issue that I notice. Third is the related party transactions, where you have the promoter directors who have their own group companies, which may own significant property, and then the property is rented by the publicly listed company. The property appreciation goes to the promoters. This is just one example. There can be many examples. We've seen transactions getting routed through privately held entities before they are actually sold into the market. So all kinds of issues exist in related party transaction space. There is also this tendency for self-perpetuation and not creating enough leadership talent pool. We have seen examples of companies where senior executives just don't want to retire. They will continue in their 60s, they will continue in their 70s, as if the company, which is such a large company, has never been able to create a talent pool which can take over from them. So this tendency for self-perpetuation is also quite rampant, and we see across all companies. So we don't have to single out any company here. Having said all this, in the stack of investors who participate in equity markets, when we talk about, and I have not included that as a slide, but we all know that there are retail investors, there are foreign portfolio investors, there are mutual funds, there are institutions like insurance companies, then there are private equity investors, there are promoters, there are key managerial personnel or KMPs, and there are senior executives of companies, there are traders, there are speculators, and then there are retail investors. So there is a stack of investors who have different levels of information, with all the insider trading regulations, etc., in place, and with all people, obviously complying with them. There are still some limitations in that space. Again, today I don't want to labor into that. But all the point I want to make here is that among all the investors, it is the retail investors who have the least information. So even in the companies that I invest today, I don't claim to have more than 30 to 35% information about the reality. I have a 25 to 35% information about companies. And that being the case, I have information asymmetry. What we mean by information asymmetry is a few people have superior information, a few people don't have enough information, and people are acting on different levels of information. And we, being retail investors, we suffer from information asymmetry because we have access to only publicly available information, right? Whereas there are insiders, there are promoters, there are senior executives who have information and who can act on it much ahead of us, right? So that also means that the information stack is completely against us. So that creates a huge challenge in what I call as establishing a value versus price paradigm. What I mean by this paradigm is that why do I invest in a stock? I invest in a stock because in my estimation, the value is significantly better than the price which is currently in the marketplace. And those people who think that value is superior to price are buyers in the market. Those people who think that value is inferior to price are sellers in the market at any point of time. And this tussle continuously goes on, as we all know, the bull and bear tussle. So for me to be able to take a serious call into equity investing, I need to derive comfort about value. And value is a product of information. So now I have information asymmetry, which is not going in my favor. So therefore, I am supposed to do a valuation in a situation where the whole thing is against me, right? So in that situation, and in the context that, I don't have any control on corporate governance, neither on the flow of information, I need to develop a technique where I can derive a much better comfort about valuation versus price. So here again, if I just want to participate in a party and talk about, equities and throw some names and, kind of show off that I know so much about companies, that's fine. That's something which I would not consider as investing. That's something which is a party gupshup. But if you want to seriously look at equity investing, we have to be very focused on this value versus price paradigm. Again, I have created some videos on that, and some of you may have already seen them also. But that is something that is a constant tussle for us as investors to continuously monitor this value versus price paradigm. During this COVID pandemic, sometime in the month of June, I also created a video on how one can take advantage of the information asymmetry which exists in the value versus price paradigm. And if those of you are interested, I can share those videos through Dhruv. In the month of April last year, in 2020, when the COVID pandemic was playing out, I had created a video on my own equity investing strategy, how I'm approaching, how I'm looking at the pandemic. And I'm very happy that looking back, by and large, the way I had kind of thought of and what I have done has been very consistent with what I had said in that video. And I worked on that plan, and I'm very happy that it has worked, absolutely very closely to what I had thought of. The other thing which I also want to mention here is, 2008, 2009 was a stark year in my life because I'd just begun equity investing. 2007, there was huge profits in the books, and I'm sure many of you would have also had that situation, but I did not book those profits. And then I was in the midst of my doctoral program. I had stopped earning, and then the collapse happened. At the bottom of the collapse, I landed up in selling my shares. So I booked massive losses. Those losses were equivalent to, 3 flats that I had sold before the real estate rally, which happened after about 2005. So pre-rally, the 3 flats that I had sold, that was the loss that I booked in 2008, 2009. So it was like a lot of distress. And at that time, I also started seeing these hollow corporate governance claims. So I did not want to run away from the markets because if I were to run away, I would have never recovered those losses. So I decided to remain stuck. I completed my PhD first in 2009, and then I started focusing on the recovery of my losses. But again, 2010, I had a very difficult year with, 2 illnesses in the family. My father passed away at that time, and my elder daughter was also seriously ill. So it was like back to back 3 years of challenges, but I did not give up, and I started working on, these issues. And I realized, that it's very important to study this animal called as market. But at the same time, I had this self-imposed code of conduct on myself that wherever I conduct workshops for companies, I would not be investing in those because I don't want, even from a remote perspective, any kind of an allegation that I use that insider information for my personal advantage. So for at least 18 months after I have done a workshop for a company, I don't invest in that company. And now, of course, I have trimmed my portfolio to just 6 or 7 stocks through this holding an investment company route, which actually, does not even create that kind of a challenge any longer. But at that time, I had this challenge because I used to have a lot of investment in a lot of companies. So after I got into these corporate workshops, I even decided to trim those for this reason. So that naturally pushed me to an alternative where I had to get over all these problems. Corporate governance problems continue to remain, but at least I wanted to have a much better value versus price comfort before I could start working on recovering my losses. And that's what I did. So here, before I go further, I would like to talk about 3 kind of companies within this domain of investment and holding companies, so that all of us are clear about these 3 entities. So investment company is that company which belongs to an industrial group. It's majority owned by the promoters or a group entity, and it takes minor stakes in group companies. Those stakes may not be very significant, though significant for that company's portfolio, but they may not be significant for the investee company. So in that case, it's not a holding company which owns 30, 35, 40%, 50% of the controlling interest in that company, but it takes minor stakes in the group companies. It also holds shares in other entities, non-group entities. So in a sense, it's almost similar to a mutual fund, in that sense. Of course, I'm going to draw the distinction and parallels with mutual funds a little later. It may also have shares of listed companies and unlisted companies, some belonging to the group, which are unlisted. Typically, those will be more belonging to the group, the unlisted space, but the listed companies could be other non-group entities also. Typically, the primary source of income is capital gain, interest, dividend. They are the primary sources of income, out of which they declare their dividend to their shareholders, right? The prices typically trade at a significant discount to NAV. This is where, as compared to a mutual fund, where when we buy a mutual fund unit, which is an open-ended scheme, typically we are able to buy and sell at the NAV itself. Whereas in case of these investment or holding companies, the prices usually trade at a significant discount to NAV. I will talk about the logic of that discount also a little later. But that's a fact that I just wanted to mention here, that if you were to actually calculate the NAV or source the NAV based on quarterly results or from their website, then you would find that the price is at a significant discount. And typically, they are zero debt entities. So another thing which I had to also think of as a part of my own investment strategy is this careful choice of whether I would like to go for high beta, which means typically high debt entities, or I would like to go for low beta, which are typically low debt entities. And I made that conscious choice because, as I already told you the background, since I had to recover my losses first before I started to generate good returns, obviously I did not want to add risk. And almost for the last 20 years after I had given up my corporate life, and I do consulting or corporate workshops by invitation, I have not been reaching out to anybody. It's only by invitation that I do. So there is a lot of uncertainty of income also, unlike salary earners who have money coming to their bank account, with surety. So obviously I did not want to get into, building more risk on my portfolio. Though, of course, at a personal level, I had no debt, but I did not want to indirectly invite debt by investing into companies which were high debt and naturally high beta entities. So typically these investment companies are zero debt entities. So that suited me also. The other set of companies are holding companies with no operating business. Here, the distinction between an investment company and a holding company with no operating business is that the investment company has relatively minor stakes in the group, whereas the holding company would have significant, they're not necessarily majority stakes, but they are reasonably significant stakes, which matter and which can defend, for example, a takeover by another entity. So these are holding companies with no operating business. They have no other operating business. So in that sense, they are similar to investment company, but the distinction is that their stakes are reasonably larger in the group entities, but again, need not be majority. But it does not mean that they don't hold shares in other entities. They can continue to hold shares in non-group entities also, but relatively the weightage of the group entities would be significantly larger as compared to non-group entities. Then we have another animal called as holding company with operating business. So here, what happens is this company holds reasonably large stakes in group entities, but at the same time, it has its own operating business, which may not have anything to do with the group entities. So they may be unrelated to the group entities. And because of this operating business, they declare dividend not only out of their capital gains and dividend income out of the stakes in group entities, but they also declare dividend out of their own operating business. And here again, the price usually trades at a discount to NAV. So where there is investment portfolio plus the operating business, which has its own valuation. So if you look at the analyst reports published, as well as people giving their own opinions either through YouTube videos or in the press, typically they would be talking about there is an operating business's valuation plus there is what they call as a holding company discount on the investments that they have in turn made into their own group entities, which are also listed entities. So because these entities are highly researched, the discount typically which exists on while putting together, the valuation by these analysts and recommending this stock, they call it as sum of the part valuation and so on. So while doing that, they would give a certain amount of discount to these group entities stakes that they have. And what I used to find earlier was that they would typically give a 30% discount while doing this valuation. And I'll later on talk about my understanding of tax laws. Some of you are experts in that. So again, you can correct me wherever I may have gone wrong. But the point I want to make is that in the earlier days, there was a very inefficient taxation system as far as these investment and holding companies was concerned. And therefore, there was typically a 30% holding company discount, which was given by these analysts in the valuation. Of late, I see that analysts have started giving 15-20% discount as the taxation regime has also changed, but the discount has narrowed. So because these companies are well researched and there's a lot of visibility, naturally the discounts have also shrunk. But that may not be necessarily the case with other entities which are pure play holding companies or pure play investment companies, where the discounts may be still larger than what the analysts typically give, particularly because they're not so well researched or they're not necessarily on the radar of investors. And typically, as we all know, that valuation has a lot to do with the cash flows. So wherever money flows, valuation tends to go higher, though from a conventional PE ratio or such metric, we may find that those PEs are obscenely high. Neither are they supported by the growth, so what is called as the PEG or power P ratio. But nonetheless, they continue to have high valuations because of the cash flows which consistently continue to happen. In these companies, the last point is holding companies with operating business. They may also have a lot of debt on their books because their operating business requires debt. Unlike the previous two companies, the investment companies and holding companies, which are typically zero debt entities. So I just wanted to make a distinction between these three categories of companies. So if you are investing in such companies, whether you are investing in investment holding or even these companies, you have to be comfortable, particularly in this category of company, with its core business plus the associate companies. So that's the broad picture of investing here. Now, I would like to draw a comparison with mutual funds so that we are all on the same page, because some of you, of course, I know that many of you are savvy equity investors and therefore may not be investing in mutual funds, but like I personally don't have any exposure to mutual funds any longer because, of course, that's a subject matter which is completely different. But we all know that worldwide the experience is only about 8 to 20% fund managers are able to beat the index. The balance 80% funds either perform as per the index or lower than the index. So personally, I have been advocating index funds as the best way of investing among mutual funds, because at least you have the certainty of where the money is going, unlike so-called managed funds where you have no certainty on what the performance is going to be and the past track record may not necessarily get repeated. So, but that's a separate subject matter. Here, I'm just talking about the broad, mutual funds as a way of investing versus investing through holding and investment companies. So you have a good comparison. So there are certain advantages of investing through holding and investment companies versus some disadvantages. So I want to share both so that you are able to take a considered view. The advantages are that unlike a mutual fund, here a share you are able to buy at a discount. So that's one major advantage. Whereas a mutual fund, you'll have to buy at the NAV. Here you are able to buy it at a discount to the NAV. Discount may also fluctuate, creating opportunities. So in the case study that I created in the month of June, I have explained how the fluctuation in discount was a great opportunity, where without actually investing even a single rupee, one could create an arbitrage across companies to be able to make money without even investing a single rupee. So this fluctuation of discount itself can create opportunities. Third is we broadly know the portfolio. It's not that in mutual funds we don't know the portfolio, but what happens is because these are typically group entities, they are not going to trade in their own group investments as much as the churning that can happen in a mutual fund. So mutual fund, again, you can get the disclosure about which investments they have, and my understanding is that every month they will give a disclosure of their scheme. So you can also track that and be comfortable with what investments they have. Here in investment and holding companies, because they are affiliated with certain groups, you already know that what exposures they have, and that exposure is not going to fluctuate. And my experience in last 12 years is that that hardly fluctuates. They, if at all, they keep on adding to some extent if they have some money, but they don't sell off those investments because they are essentially their own group investment or holding companies. But they may do trades in other entities, which are non-group entities. And to that extent, there is a bit of a surprise that we may see from annual report to annual report. So every annual report, you need to actually again go through the portfolio and check what changes have happened between last year and new year and update your own data file to that extent. But apart from that, and again, I have also created a video on this where I have even given a tool for people to actually download that Excel file and populate data for themselves so that they can themselves make an assessment of the NAV. So all that, those tools are in the public domain. I have already shared them. You can share your request to Dhruvaji or Dere sir, and I'll be very happy to share those videos with you where they are downloadable Excel files also. So you can monitor your own portfolio with reasonably good accuracy of about 95% in my experience, where because you can take a decision of the value versus price paradigm comfortably and decide to take a buy or sell decision appropriately. Again, some of you may have specific comfort with a particular group. So instead of buying a lot of companies from that group, you may find value in investing in a company which invests in those companies in turn, and you are indirectly getting those at a discount, right? So that's something which is very useful. It also helps in mind management. I actually suffered. I have come to this conclusion that there are two pillars of investing. One I call as cash management, and the other is mind management, apart from the risk management part about which I spoke earlier. But cash management and mind management are two important pillars of investing in my view. Cash management is being able to have cash at the time when you feel there are opportunities, and you should be able to take those decisions quickly. So I'll not elaborate much on the mind management part, but the cash management part. But on the mind management part, it's very important that as a part of our investing strategy, we are able to manage what I call as the mind monkey. This mind monkey can create fear in our mind, which is what I did in my mind in 2008, 2009. And when I should have been buying stocks, I was on the other side selling stocks, and I actually gave stocks cheap to people, right? On the other hand, when the COVID pandemic struck, before the COVID pandemic, as I have shared in my video, I had more than 80% exposure to equities. And when this thing happened in a very short period, my personal portfolio came down by 45 to 50%. Now that is something which can naturally create a lot of panic in your mind. But because I was very clear about this value versus price paradigm, now this is where I would like to elaborate one more thing, which is again, in my view, very, very important in equity investing, but not given such a serious attention that it deserves. Or at least I think it may not be given that much of attention. Perhaps there are a lot of wise investors here who may be already giving a lot of due attention. There is generally a lot of focus on price versus cost. So for example, in this 2020 panic which happened, people, as they realized that the price which was prevailing in the market was going down below their cost, they panicked and they went into selling. This is exactly what happened with me in 2008, 2009. As I found that the prices had gone below my cost, the panic kicked in because, obviously I was not earning that time consciously because of my doctoral program at IIT, which itself was very demanding. There are a lot of roadblocks in the doctoral journey, in the PhD program, among our PhD mates. We used to often joke that you're not worth a PhD, particularly from IIT, unless you have got some too serious depression on the way. Because it's not, of course, today we know that PhD is not as difficult in many other places, but at least in IIT I found that it was quite challenging, and if you have to do a very data-driven doctoral work, there are a lot of roadblocks there, and so as it was a depressing journey in that sense, though it was very fulfilling, but because of the roadblocks and then the equity market collapse. So moment I saw that the prices were going down below the cost, and a conversation with my own brokers, instead of reducing my fear was further fed into by giving me some new price targets in the market in terms of how the market is going to further collapse. I naturally booked my losses. But what I had not developed that time, which I was able to develop over a period of time, was a paradigm where you should not get panicked by the price versus cost paradigm, but you have to be very focused on value versus price paradigm. So as far as you know that the price collapse is nothing to do with the value collapse. The value is intact, and if you are able to take a view beyond the short-term problem, which is what I tried to do in my video 19, which I had released on April 4 in my equity investing series, where I spoke about my view about the pandemic and how this is a short-termish problem. Of course, it's very catastrophic for people who go through this, and I have all the respect for families who have battled this. I have lost a few batchmates to this pandemic, but I'm talking about the bigger economy and the market. So from that perspective, it is something where, as a dispassionate investor, if you have to take a dispassionate view, what you need to actually see is the value versus price versus cost paradigm. And moment we start doing that, and we are not focused on the price versus cost paradigm, even if our price has gone below the cost, because there is an inherent value in it, we don't panic. And that is the key to mind management. And this time, while I had seen a much starker fall and a much quicker fall than the Lehman Brothers crisis, I was actually able to I was on the right side of fear, and I was able to create strategies which, while I managed my mind better. So that's where, again, I found that the investment and holding companies came quite handy rather than individual companies, because individual companies, we are not able to assess to what extent the impact of the pandemic is going to be very severe on them. We have to react based on the information in the public domain, and to that extent, we don't know whether for how many days the factory is shut, and how is their supply chain working out. Later on, of course, some leaders come and talk, and we get to know about it. But the panic when we have invested in individual companies is far more severe as compared to when we have invested in a larger set of entities, where we have a good handle on, so to say, the net asset value or the NAV of that investment, and therefore a better judgment about the value versus price versus cost paradigm. And therefore, as I said, through the tool that I earlier spoke about, we can estimate the NAV. We don't have to rely on their disclosure in the quarterly results. We can estimate the NAV ourselves and are able to take this call about the paradigm that I just spoke about. One thing where there is an advantage as well as there's a disadvantage is dividends are paid out and we have no choice. Personally, of course, I'm not a mutual fund advisor or anything like that, but I do conduct workshops, either a part of the NGOs or on some other platforms. And my recommendation always to any investor is that wherever you have a choice, you should never get into receiving a dividend or any kind of recurring income. You should rather allow the growth to compound. But in case of companies, as we all know, we don't have a choice. Company declares dividend, we receive it. So in that case, to that extent, it's an advantage because we are able to de-risk our portfolio. To the extent the money comes out of the market, it is a one way of reducing our risk. So as a part of the overall risk management, dividends are a good strategy. However, dividends being received simply because I want some current income into my bank account is not a good strategy. So I'm drawing a distinction between dividend as a good de-risking strategy versus dividend or income oriented investments where some money keeps on coming into my bank account and then remains at a very low rate of return and doesn't give me the compounding advantage. The disadvantages are that historically there have been discounts to holding and investment companies due to tax inefficiency. Also, the tax inefficiency I'll talk about a little more later on because there have been certain changes in the tax laws also. So in that context, I'll talk about the tax inefficiency. But also there is a bit of a concentration of risk, no diversification, because you are exposed to one particular group, one set of companies. And typically, as we all know, that for diversification, at least 18 to 20 stocks are required. But here again, one good thing is that indirectly through a limited number of investment or holding companies, you are able to achieve diversification. Also, if you are very clear about, the groups and which companies do you have exposure, and are you comfortable with the overall exposure, taking into account, the indirect holdings of these companies, is it something which you are comfortable with? Then you are able to achieve diversification even with the holding and investment companies. But here, generally in mutual funds, the diversification is generally better because they are not allowed to have concentration of investments into one stock. There are limits in terms of how much they can invest in one stock and one industry. So automatically they are forced to diversify. Also, what happens is monitoring of underlying companies in investment and holding companies is required. So I participate in investor calls in which I don't even have a single share, but I still participate because whatever happens to those companies is indirectly going to come and impact my value proposition in these companies. But instead of directly investing in those companies, I go through a route where I get to invest in them in a discounted fashion, creating that upside for myself down the line. But at the same time, I have a better handle on the value framework, value price cost paradigm. But nonetheless, monitoring those companies like you would do for your own other companies if you were to directly invest in shares without going through investment or holding companies or mutual funds, even that would be still very much required in case of these investment and holding companies also. Whereas in case of mutual funds, you're not required to do that because you are getting into a bit of a passive investing there. Also, in case of holding and investment companies, you don't have the choice of growth schemes. You have to receive dividend come what may. Whereas in case of mutual funds, you have the choice of growth schemes, right? Also, in case of these investment and holding companies, as I already mentioned, these companies are not likely to sell stakes of their own group entities unless there is some compulsion, but I have not seen that happening. On the other hand, they may keep on adding wherever they have an opportunity. Whereas mutual funds don't have that overhang. Mutual funds can be free to sell any share and buy another share with complete freedom. And that freedom doesn't exist fully in these investment and holding companies. So that is something that we also need to be aware of before we invest. Also, unlike a mutual fund where at the end of the day, at least you can get the NAV here, the NAV you need to estimate yourself. And of course, at the end of quarters, you can get a good handle on the NAV. But by the time the quarterly results are declared, it may be another 5-6 weeks. So by the time you get to know that NAV, it's already historical data, exactly like any financial statement. So you need to have that tool yourself, for you to calculate and at least estimate the NAV with a reasonably good certainty, at least 95% accuracy, which is reasonably good for our decisions. Comparison with other stocks, the advantage is you are able to achieve diversification with less number of stocks. So that 18-20 that you need to do, you can do with like what I do with just 6-7. So diversification can be achieved with less number of stocks. There is also a possibility of discount shrinking due to change in tax laws, about which I'll talk about a little later. So far, the evidence doesn't show that the shrinking of discount has happened. But I have a reason to believe that this shrinking of discount can happen, about which I'll talk about a little later as we talk about the tax regime change. Also, this is not widely followed, and hence an opportunity over last 12 years. Sporadically, I have seen people talking about it. Sometimes I have seen articles coming either in the papers or on some of the popular portals where they talk about it. But I think that enthusiasm fizzles out because of one reason, which I'll also talk about a little later in terms of some of those challenges. I will talk about a little later why sometimes people are not very enthusiastic about investing through this holding and investment company route, because sometimes it can try your patience. So as they say, equity investing is about patience, but here the patience could be tried for a longer time. But I'll talk about that part a little later again. And therefore, this is not a very widely followed investment kind of a strategy. I think our own investor cell is so old. I think it is easily, I think, founded in the 80s. So clearly, more than almost 40 years we'll be completing. But I don't know whether any time you have even talked about this subject of investing through holding and investment companies. It's not a widely followed. And in fact, that's the reason why I think it's an opportunity, because, it's my conviction. So after I recovered all my losses, after I came out my bad family patch, it took me another couple of years before I was able to recover my losses. And then I regularly monitor my returns since then. And generally, I have done quite well in terms of the returns. And one of the things that I have noticed is that if you want to generate superior returns in equities, if you were to follow the herd, you will never make those returns. Because anything which is so widely researched, the chances of you making money, and I'm not talking about necessarily only investing and holding companies. That's the reason why people go for mid caps and small caps and micro caps, where they are not on the radars of investors, and which I have also done. So that is something where the value unlocking can happen significantly, and therefore doing something different than the market, different than the herd, is always a way that you can generate returns. Apart from the overall thought that when everybody is fearful, you should be a buyer, and when everybody is very gung-ho about the future, you should be a seller. So apart from that, I think even identifying opportunities which are not widely followed always create opportunities, though it may mean slightly higher risk. But finally, as I believe, risk is a risk till you understand it. Once you understand a risk and you start managing it, it's no longer a risk, because you have learned the art of managing it. So that's why personally I follow what I call as a defensive investing approach. Today is not the occasion to talk about it, but that is an approach where you actually manage your risks better. What are the disadvantages? This is where I said that the patience could be tried. There could be mismatch between the NAV growth and the price growth. So you realize that the NAV is going up, but the price is not budging. And some of you, of course, follow technical analysis. And I'm not a technical analyst, but I have attended a course. And I think there are some useful approaches which also, help you to kind of develop patience. For example, some of you may be familiar with this flag pattern in technical analysis, where you have the pole of a flag where the price rises and then it gets stuck in a range for a long time, and that's the flag. And then finally, that eventually the pattern may get broken out, or there could be a fall from that pattern. But if the company is good, then sometimes, obviously it will create a breakout from that range, and the stock will fly again. And as they say, to the extent of the height of the pole, right? So, but it can try your patience for a long time. So this is something which also I observe in case of these holding and investment companies, that it can remain range bound. Nothing happens in that price for a long time, though the NAV has gone up. But you don't have a loudspeaker system whereby you can announce, hey, the NAV has gone up, please buy. And it's up to people to actually make that judgment and buy or otherwise, right? So there is always this risk that discount may also remain, because finally, if it is not researched, and what happens is finally the price in the market is a factor of cash flows, how much money moves into those stocks. and cash flows is a factor of how well it is researched. So if it is well researched, money will flow into those stocks, like you would find typically in the context of companies which have their own operating business plus holding into or holding holdings into other group companies. There, because they are well researched, money has already flown in. The discount may shrink there, but it may not happen with the holding and investment companies. So this discount can remain stubbornly high for a very long time. Um, Also, you may find in some holding and investment companies is that there may be multiple group entities. There are some group entities which are doing extremely well. They pay good dividends, but a part of that dividend gets diverted to companies which are always sucking capital. They always are in need of capital for further growth. So that dividend which is received by the company may not ever reach you, because this dividend may get diverted towards some capital investment which is happening in the other companies, and they may be subscribing to additional shares by way of rights or whatever that is. So the dividend income may get sucked into further capital infusion. So if you notice that, you have to be concerned whether that business which is sucking cash is going to break even and is going to be profitable down the line. So that diligence is something that will be required in these companies. Now, I would like to talk about this tax regime change. And of course, we have authorities here in this group. Veeresh sir himself is an authority on these issues. But whatever I have understood in the 2020 budget is something I want to share with you. And that's the reason I feel that, this is an opportunity which can, very good. For me, who has been in these kinds of investing for now 12 years, for me, whatever tax regime change related benefits which are going to come are going to be a top up for me, because that's not the primary reason why I invested. Neither did I anticipate that this change would ever happen. But this change did happen in 2020, which we all know, but I'm going to talk about this. And perhaps if market starts valuing that tax regime change at some point of time, there could be an upside to these holding and investment companies. But for those of you who have never invested in holding and investment companies, you have to really study the impact of this tax regime change and what it would mean to the discounts and what it would mean to the dividend payouts of these companies. That's a study that you will be required to do so that you are able to take a considered view, because without understanding the tax regime change and the implication of that in the respective investment and holding companies, for those of you who have not been taking this route for a significant part of your investment, then you have to do this diligence and of course consult your CA and to really confirm what I'm saying is whether right or not, or if there are any holes in this point of view. So the earlier tax regime was clearly less advantageous for these companies, because the dividend income that they would receive, they would have to pay tax on that dividend income. And as all of you would know that earlier there were this taxation regime called as minimum alternate tax. So while for other investors, that we all know that for retail investors, we did not have to pay any tax on the dividend because it was completely tax-free at our hands, unless the dividend income was crossing the threshold of 10 lakh rupees. So for the excess, we were supposed to pay tax on that dividend. But otherwise, at individual level, we did not have to worry about tax on dividend. Whereas companies which were receiving dividend, even if technically speaking, they had no obligation to pay tax from the regular corporate tax rate perspective, they were obliged to pay a minimum alternate tax. So the other thing which was on top of it was that they will have to again pay dividend distribution tax on the received dividends, and they would have already paid dividend distribution tax indirectly, because the company which was paying dividend would have already paid it. So they would naturally receive less dividend than the potential, because a part of that was going to the government. So their dividend inflow was jeopardized. On top of it, on the received dividend, while distributing dividend, they would again have to pay a dividend distribution tax, unless their holdings were more than 50% in their group companies, where, as I remember and understand, they would get certain benefit while paying dividend distribution tax, because indirectly they have already paid dividend distribution tax on the dividend income that they have received. But if the holding and investment company did not have more than 50% holding, in that case, that benefit was not available. So I would imagine that for many investment and holding companies, this benefit was not available. However, in the new tax regime, it has become more advantageous, because as we all know that the whole taxation system itself has undergone a change. Apart from we at individual level paying tax on dividend, and therefore dividend distribution tax itself has gone. Now what happens is that typically, as you would have experienced in this year, though it was a COVID year, those companies which have done well have started grossing up their dividend payouts for the earlier dividend distribution tax. So if earlier they were paying 100 rupees by way of dividend, they were paying 20 rupees to the government by way of dividend distribution tax. So now they have upped the dividend to that extent. So now the dividend payout will be 120 rupees, because what was going to the government has stopped, and those who receive dividend will have to now take care of their own taxation. But one other important change which has also happened is Section 80M, where if a company is receiving dividend, and this is the first year when they will actually get the benefit, year 2021. So at least 1 month prior to the due date of filing their tax return, which let us say is 31st October. So by 30th September, by which time anyway companies are required to hold AGMs, if they have distributed at least that much of dividend that they have received, then they would not be required to pay tax on the dividend that they have received. And what I understand is that is now the overall tax regime. There are options where there is a lower tax regime for companies where they give up all the other benefits that they were otherwise entitled to, including, I think Dere sir can guide us better, which all aspects they have to give up to opt for the lower tax regime. But under the lower tax regime, Section 88 benefit is protected. And what I understand also is the MAT related taxation is also not applicable for such cases, and therefore the payout of dividend from holding companies can actually become better. So therefore the gain can be visible in two ways. One is lower tax payout and higher dividend payout. So this is what something which can happen, and we would watch and see how that pans out during the next financial year, because these holding and investment companies would have received their dividends last year. So they would have received typically larger dividends than normal. Of course, subject to the COVID related challenges. So some companies may not have declared as much dividend. And now when they actually start seeing those dividend and start reporting into their own quarterly results, we can also see whether the tax provisions that they're making are lower than what they were making in the past. So if that is what is happening, then what I'm saying gets confirmed. And then, however, it may try patience, because by the time we see those quarterly results, and it may take a few more quarters. So it may try patience. And once the dividend payouts increase, people may start looking at the discount all over again, and the discount may also shrink. That is a possibility that I'm talking about. I cannot obviously vouch about the future. And as I already mentioned, because I was investing in these companies irrespective of this benefit, for me, this is going to be an additional benefit. But for those of you who are going to turn to this investing for the first time, I would caution you that you'll have to study this aspect. Also, maybe as a part of our own investor guidance cell, there could be a more discussion on this Section 80M related provisions and what it would mean, or the overall dividend taxation change, or you may have already had that discussion. So that is something you'll have to factor before you turn to this. Now the question is, how do we get the NAV data? Typically, along with the quarterly results, these companies do declare their portfolio value. Then what is the portfolio value of those holding companies? And some companies even declare their NAV, so to say, on their own website in the investor section. So you can also look for that, though these are not many companies do that. but quarterly results, they have to give their portfolio value. From that also you can derive the NAV. How do you get the NAV? If suppose the portfolio value is 20,000 crores and the total number of shares issued by the holding company are 10 crore shares, then 20,000 crore of the portfolio divided by 10 crore shares can give you a very quick and ready method of that calculation. Also, in the annual report, you get an idea about the portfolio holding. And as I mentioned, they typically will not sell shares out of the group, but they may churn the other part of the portfolio. And once in a year, you may have to update your own Excel file because that is the basis that you'll be using for next year to make an estimation of the NAV without waiting for the quarterly declarations. So you can always update that with the current price data. Then you can use your own thresholds to say that, I'm not going to update every price, but major holdings I will update just to get a good handle on this. Just for those who are curious to derive the NAV yourself, basically, as we all know, there is a fundamental equation of the balance sheet, which is equity plus non-current liabilities plus current liabilities are equal to non-current assets plus current assets. I'll not go into those technicalities. I think anyway, if you are interested, I can share my even learning finance video series and even equity investing series where I have talked about all these nuances in greater detail in terms of valuation and how this NAV can be calculated and so on. So those of you who are interested can see those details. Solving the same equation for equity, as we can see, the non-current assets plus current assets on the right-hand side, if you push the non-current liabilities and current liabilities on the other side, you will find that typically the equity can be derived as non-current assets plus current assets minus non-current liabilities minus current liabilities. Now, the current assets, non-current liabilities, and current liabilities, and typically for pure play investment and holding companies are very minimal. There are hardly any. You can simply ignore them also. So typically, therefore, your focus would be on that equity will be equal to non-current assets, which are going to be the investment portfolio. Of course, some of them may even have some land building. That's okay. That even if you ignore and even if you focus on their portfolio, which will include equity plus fixed income, then you'll have to just update that template and start monitoring that yourself. So if you do that, and they may have even fixed income instruments and unlisted securities to which you can even put some estimates of value. So what can be done is that, as I am going to share that video, I have given that template which you can simply download and populate all this. So quantity into current price will give you the value of each investment of that holding company. And if you take a sum total, which is what that Excel file can do for you, you can get the NAV per share on any day that you want. And that will be a good estimate of the NAV. You can reconfirm it at the end of the quarter, whenever. But my experience is that's all not really required. So you can get a very good handle on the NAV without the company declaring it. So once you do that, as I said, those interested in using a template, I have a few videos which I can share with Dhruv, and you can download the template also. So you have a ready file for you. Now, what I want to share before I close, how well I'm doing on time, Dhruv or Sujit?
You have 10 more minutes. You can easily go. Yeah.
Okay, fine. So what I thought, and again, as I mentioned at the beginning in terms of my disclosure, these are just names which you can use as a starting point. I'm not recommending any of these names. It's up to you to actually pick and choose which companies you want to actively research on and take a decision. But very quickly, I want to talk about names, and these are in alphabetical order. So these are not like my preferences or anything like that. And as I said, I don't talk about my own investments because I don't want anybody to be biased with it. It's for everyone to take that call. So one example is Aditya Birla Capital, which itself is a holding company of Aditya Birla Group, which holds stakes in various financial services businesses of Aditya Birla Group. Second is Bajaj FinServ. Bajaj FinServ holds 52% of Bajaj Finance. It holds 75% of Bajaj Allianz Insurance. Life insurance, it holds 25% of Bajaj Allianz or 74% of Bajaj Allianz life insurance, Bajaj Allianz general insurance. It has other companies such as Bajaj Finserv Healthcare, Bajaj Finserv Markets. So they have created other companies which are not subsidiary of Bajaj Finance, but they are subsidiaries of Bajaj Finserv. They also have a company which is for distribution. Then Bajaj Holdings and Investments Limited. Bajaj Holdings and Investments Limited owns about 33% of Bajaj Auto. It owns about 39% of Bajaj Finserv. It owns 51% of Maharashtra Scooters, which is also another holding company of that group. Then Bamal Lorry Investments Limited has significant stake. I forget the percentage, but in Bamal Lorry itself. So you have Bamal Lorry also is traded in the market, and Bamal Lorry Investments is also traded. But as I understand, Bamal Lorry has stake in that company, other company which is listed. Then Bengal Assam Company Limited, I think it belongs to the JK Group, Singhanias. So you can explore that. Then Bombay Burma Trading Company Limited, it belongs to the Wadia Group. Bombay Burma owns stakes in Britannia, Go Air, and a few other companies which you may like to explore. Right? Godrej Industries Limited. Godrej Industries Limited is not a pure play investment and holding company. It has its own operating business within Godrej Industries Limited, but it also has stakes in Godrej Consumer Products. It has stakes in Godrej Properties. It has stakes in Godrej Agrovet, for example. So this is Godrej Industries Limited. Then Grasim Industries Limited, which again is a Aditya Birla Group company, which has an operating business and plus stakes in other group companies. Housing Development Finance Corporation has its own core business, which is housing finance, but also has stakes in multiple entities belonging to HDFC Group, right from HDFC Bank to HDFC Asset Management Company to HDFC Life Insurance to HDFC. They have a company which is in education finance space called as, if I remember right, Credila. So there are multiple entities in which HDFC would have stake, right? So in that sense, then there is JSW Holdings Limited, which is a holding company belonging to the JSW Group. You all know JSW Steel, JSW Power, but you'll have to actually check exactly their holdings. Kalyani Investments Limited belongs to the Baba Kalyani Group, which has a stake in Bharat Forge and other Kalyani Group companies. Then Kama Holdings Limited. Kama Holdings Limited again belongs to the SRF Group, Shriram Fibers Group. Bharat Ram, but originally it was the whole DCM, Delhi Cloth Mills, which got split into Shriram Fibers, one group, and DCM Shriram is another group. So it belongs to one of those groups. You can explore that. Then Larsen & Toubro is again an example of a company with its own operating business, whether it's defense, civil construction, etc. But they also have stakes in other companies, including L&T Infotech, L&T Technology Services, L&T Finance Holdings, and of course they acquired another IT company last year, in Mindtree, as we all know. Then L&T Finance Holdings itself is like a holding company of various financial services entities within L&T Finance Group. Then we have Maharashtra Scooters, as I mentioned earlier. Once upon a time used to make scooter, but no longer makes it, but it is more of a holding company which has stakes in, I think, Bajaj Auto, Bajaj Finserv, Bajaj Holdings itself, and Bajaj Finance. So that's other. Then there is the Pilani Investments Limited, which is the holding company again belonging to the Aditya Birla Group. So that's something again you can explore, where they have stakes in various companies. And Rane Holdings Limited, which is from South India, they have various Rane Group companies in which they have stakes. Reliance Industries Limited itself is an example of a company with a operating business, but also stakes in say for example, Jio and Reliance Retail. So in that sense, it is also now a holding company from that perspective, but also has its own operating business. Sundaram Finance Holdings, again, is another holding company belonging to the Sundaram Group. And lastly, this is the Tata Investment Corporation, which has stakes in various Tata Group companies and also various non-Tata entities. So I thought of just sharing. Now, again, this may not be an exhaustive list, but whatever I have come across, I have tried to make a list for you. So at least you have a starting point to start exploring this journey if you're not explored. So how to select the holding and investment companies? First of all, the underlying businesses have to be high quality businesses that you should be comfortable with. So as I mentioned, investment and holding companies is not an end by itself. It is a means to get an exposure to certain other companies. And therefore, keeping track of those underlying businesses is required as investors, and that we cannot wish away with. But at least we need to be comfortable with the high quality underlying businesses, and we should be able to do the diligence. Personally, I prefer low debt companies, of course, because one, I have my exposure to equities is beyond any norms that typical financial planners would talk about. So they would have recommended to me 50% of my portfolio. Pre-COVID, it was 80%. Now it is 90% exposed to equities. So naturally, from risk management perspective, I would not prefer any high debt company in my portfolio. So in my case, there are more low debt holding or zero debt holding and investment companies. Examine their quality of reporting about the underlying investments, the NAV, how frequently are they declaring, how delay, what happens in their holding of their board meeting after the quarterly closing. So those things, and look at the liquidity aspects, because typically since not much money flows into that, sometimes it could be frustrating that you may place an order, but it doesn't get executed because the liquidity aspect is not very good as compared to their underlying companies. The underlying companies, the liquidity aspect would be very good, but here you may have to, the bid and offer paid could be quite high, and if you have placed an order and forgotten about it, there is a chance that the order may not get executed also. So that is something that, or when it comes to, if you are determined to buy, you may have to sometimes pay that bid and offer spread to be able to buy that stock. Or the same problem while selling, that if you have decided you have to sell, then you may have to sell at a slightly lower price than you would have loved to, right? Also, you have to look at their dividend payout policy and the risk of dividend diversion. So if there is a group entity which is sucking a lot of cash, then because of their own expansion plans, then what I talked earlier about dividend may not hold true. You may not receive all the dividends that you would see in their income statement. Whereas other companies, I would see that gradually the dividend payouts would go up, because why would they pay tax and hold that money back? They would rather, if they don't need that cash and they're going to be more passive investors, then might as well they distribute more dividends. So as I expect, the dividend payout policy of some of these companies can be more liberal in the future. So that's my conjecture, and as I already mentioned, I could go wrong in my conjecture. Again, before I close and thank all of you, I just wanted to say that from my perspective, I turned to this investing out of the fear that I had suffered from. So I turned to these, and also the corporate governance challenges that I had seen. So therefore, I turned to this, and therefore, significant part of my exposure is to such companies. For those of you who are going to make a fresh start, I would request you to do more diligence, because nobody should just get carried away with anybody's point of view, and therefore based on that, you kindly take your decision. So that's where I would like to thank all of you for the patient hearing, and I think I have adhered to the time that Sujit has given. So with that, I'll stop sharing the presentation, and then we can have the Q&A depending on the time which is available with all of you.
Thank you, sir. Waiting for Mr. Derry to, if
Vijay,
he has any specific question to.
a question. You mentioned about three types of these companies, holding companies. Which one will you prefer? That is a company like a pure investment company, or company like having its own business, or the company having a major stake but not having any other investment or business. Which one will you prefer?
So basically, Nidhi sir, thanks for the question. What I would say is that if the operating business has high debt, from my personal perspective, I don't prefer, getting into investing companies which have high debt, particularly because, it's always a trade-off. You could have a limited equity exposure and then, be more creative with your investments and, get into even high beta space where it is possible to generate superior returns than the market performance. But the conscious choice personally I have made, considering, my own stage of life as well as the nature of regular income that I receive and uncertainty associated with that with my professional endeavors, I have preferred a route which is zero debt. And therefore, out of the categories of companies, I restrict myself to the first two categories, which is investment companies or holding companies without any operating business. So
Okay.
that's the way I look at it. But those who are on the younger side and who want to add more risk into their portfolio can look at the third category of companies, which is itself maybe more debt onto the balance sheet. And but from, as we always say, that high beta is not necessarily bad. High beta stocks have a potential for giving you higher returns, because if you time the market well, and from that perspective, it can be an excellent opportunity getting into high beta. But I have stayed away from high beta because of two reasons. One is, of course, the uncertainty of income and my age profile. And second reason is because I have a very high proportion of my investments into equities, which defies any conventional financial planning wisdom. So with more than 90% exposure to equities, naturally I preferred zero debt.
It's an interesting question by one of our members. Is it advisable to young investors to start an SIP in investment company?
So I'll break that question down into two. One is SIP and investing. First of all, SIP, I've already created a video on SIP myths and reality. I'll be very happy to share that video also with Dhruv. To my mind, mutual fund as an industry has created this myth that nobody can time the market. Whereas, I can bet on this, that every fund manager who manages others' funds, when it comes to personal investments, times the market. So while it's a great thought to others that nobody can time the market, when it comes to personal money, it is always timing the market. Stock options are a great example. I have never seen a company issuing stock options when prices are in a booming zone. Stock options always get issued when markets are crashed, right? So people are timing the market, and therefore SIP is not a smart way of investing. It is always good to understand the market movements and put our money to work. And it's not difficult. I mean, charts are all over the place. We can actually see how the prices move. And therefore, if we develop that bit of patience and say that, I'll rather wait for an opportunity, opportunities always come. So personally, I would say that, because the first principle of investing is there's no investing without application of mind. And SIP breaches the very first principle. And therefore, SIP is not the way. But yes, surely youngsters should start looking at, this way of investing. So the question was, are they listed in the equity market? Yes, all those companies that I have mentioned here all of them are listed. The next question is it like a passive investment? It depends on how you want to treat it. You want to treat that as a passive investment like other stocks that if you are treating, no problem with it. But I have already created a video in last June 2020 how we can use even investing companies a very small portfolio to create intelligent churns whereby you are able to make money without putting an additional money to work. So in my video of April 4, 2020, I had even mentioned this, and that's in the public domain. I'll share that if you're interested. That at a personal level, I had very limited cash that I could further put to work in the markets when the markets had fallen. So I had even mentioned a plan in which I'm going to do it, and I did exactly that. But I had also mentioned there that the market is throwing wonderful opportunities arising out of the value price paradigm, where on one hand, the market is all knowing, all powerful, and we as individual investors are nobody in front of the market. But at the same time, my observation over the last 15 years shows me, and particularly last 4 or 5 years shows me, that there are pockets and pockets in the market where people have not even discovered the value, right? And money does not flow there, and that's why it remains undiscovered. The analysts never talk about it. It remains undiscovered, but you actually can find out such companies and make investments. And that's where there are the way the prices fluctuate among these holding and investment companies. So one of the things, one benefit which I have not talked about on the slide, but which I can talk about now in the context of this question of passive versus active, is that particularly when you have a very large equity portfolio, you have 30 stocks, 50 stocks, 20 stocks, 15 stocks, you're not able to observe the comparative movement of stocks. And this is where a limitation of both fundamental and technical analysis is, that you're looking at stocks individually, you're not looking at stocks in tandem. But if you start looking at stocks in tandem, you can actually create opportunities within your portfolio. And I have created that video in June 2020, masking the names, again respecting SEBI's regulations, but giving data in terms of how those value versus price paradigm could be created. And therefore, it is your choice whether you want to look at this as a passive investment or as an active investment. I look at this as an active investment because the market throws a lot of opportunities of mispricing. And as they are growth, those opportunities are absolutely too many. There is no reason why any one of us has to think of that as only passive investment. I personally look at it as an active investment, and I need to do it when I have such a high exposure to equity markets. If I were to do it as a passive investment, I would not be able to, generate the returns that I'm able to generate.
I would like to ask one question. Does
Yes.
dividend yield
Yes.
on investment in a holding company play any role in making a choice of investment? That is one question. Secondly, where you mentioned that some of the companies where in a group a few companies are making losses and a few companies are making profit, and there's a diversion of dividend earned on the profit-making company into the loss-making companies. Are the directors required to make this disclosure in the annual report?
Okay, I think great point. I'll go with the second question first about the disclosure. So the disclosure is, in terms of the portfolio. So the portfolio, you would get in the annual report what kind of shares they hold in various companies. How each of those companies is performing is something that they would comment on only if it has significant holdings in it. If it has, relatively less holdings, then they will not, be giving any commentary on those companies. So those companies will have to, by looking at the portfolio, we need to decide, whether and do our own diligence. Companies are companies which are doing well or they are facing challenges. So that is something that we will be required to do. So that disclosure will not come through. But if the holding is very significant, then obviously they will also be giving you standalone results as well as consolidated results, which will take into account, the companies in which they have significant holdings. So all that will happen. That's the way I would put it. The first question was about dividend yield. To my mind, the whole purpose of equity investing. So, what is the distinction between fixed income investing and equity investing? Fixed income investing, we essentially invest because we want a certain regular income out of it, right? So a fixed income is supposed to beat inflation. Equity investing is not only supposed to beat inflation, but it is supposed to help us in participating in growth. That's the primary reason of investing in equity. Everything else is secondary. So considering that as a situation, to my mind, dividend yield is not the primary reason because of which I would look at even the holding and investment companies. Dividend yield is incidental to me. However, because of the tax regime changes and because of the underlying investments that they have, it is quite possible that the dividend yield may go up in the future. That's an incidental thing. But that was not the primary reason because of which I turned to this investing. And as I mentioned, these changes of dividend distribution tax going away, ATM being reinserted have all been very recent, just 1 year, couple of months, but have been in it for 12 years now. So dividend yield to me is incidental benefit. As I again mentioned earlier, dividend yield to me is a good way of de-risking from the markets. That it helps you to take cash out without necessarily selling any stake. But dividend for the sake of current income is not something that should be the primary reason for equity investing, is my point of view. Of course, there can be various other points of view on this, and I respect those. But I'm just sharing my perspective on it.
Thank you, sir.
Before we go to the prayer, any other question?
There are no more questions, sir. Sujit, you would like to?
I would like to thank LIC Mutual Fund for sponsoring today's program. Mr. Patwardhan from LIC is there. Thank you, Mr. Patwardhan, for sponsoring today's program. We look forward for your continued support.
Thank you, Abhijit. We are awaiting your videos. We require Dhruva Master made a note of it, and we shall ask for those plus the present. It would be always useful to all our members.
Yes,
and
I will share that presentation also.
Thank you for joining us. Now, next Sunday, not next Sunday, on 23rd, there is going to be a webinar like this, where Mr. Yasitan, he's going to talk about the digital, how do you take care of various digital platforms while making investments in equity shares, and it will be also very useful lecture. So I required to now may I request to start the Pasayadhan.
Sir, some part of what you said I was not able to hear. I don't know whether other participants were able to hear clearly. But if you could kindly send me a message about what you have mentioned, I'll surely be sending the presentation to Dhruva ji, and he can share it with everyone else. But any other requirement that you may have, you may message me, and I'll also share the videos and links to those, which also I'll do.
Okay.
But kindly just send me a message.
Oh yeah, sure.
Yes, I'll connect separately. Yeah.
Yeah.
Thank you, sir. I'm starting the Pasayadhan.